The way we use money is changing as a result of new technologies, financial advances, and the rapid expansion of digital currencies. Nobody knows how it will turn out. Money in the future, what way will blockchain and cryptocurrencies lead us next? Allow us to explain. Welcome to KG, the Inspiration Center for Future Billionaires. How fintech innovation is reshaping the future of money, from blockchain and Bitcoin to NFTs and the Metaverse. We're on the verge of a new type of finance, one that will leverage a variety of technologies to transform how we use and handle one of our most basic tools, money. The days of withdrawing cash through an ATM, applying for a mortgage at a bank branch, or shopping in a department store are long gone. For many people, doing financial transactions of any kind has become an entirely online experience in the last 2 years. The ether is increasingly becoming the future of money, accessible via phones and laptops. Money, on the other hand, has a brighter future ahead of it, which is currently in its early phases. Cryptocurrencies and other faster, more powerful financial technologies are changing the way we think about money and putting financial institutions to the test. The year 2021 was a watershed moment for finance, and the year 2022 is shaping up to be even more so. Digital currency and blockchain. Cryptocurrency is a digital token that is encrypted and exchanged using blockchain technology in a cryptographically secure manner. With a market worth of $786 billion as of early January 2022, Bitcoin, the world's first decentralized cryptocurrency, released in 2009, is the largest and most popular. Many people have heard of Bitcoin, but few have a thorough understanding of how it works. The first thing to remember is that Bitcoin and blockchain are not interchangeable terms. The means for recording and storing Bitcoin transactions is blockchain, which is frequently characterized as a shared, immutable ledger that securely links blocks of encrypted data transactions in a network. Bitcoin is based on a blockchain network of its own. There are currently over 16,000 cryptocurrencies, with Bitcoin being the most popular. Ether, like other cryptocurrencies other than Bitcoin, runs on the Ethereum blockchain. The overall value of cryptocurrency is estimated to be around $2 trillion. However, the value of Bitcoin and other cryptocurrencies has already fallen this year as the Federal Reserve has taken a more hawkish position on monetary policy, reducing the quantity of bonds it holds and hinting that interest rates will be raised. Cryptocurrencies, which function independently of central banks and government agencies, are not immune to the global banking systems and market shocks. In addition to its market risk, critics point out that cryptocurrencies are not linked to a regulated central bank or a governmental institution, making them far more difficult, or even impossible, to regulate. As a result, cryptocurrencies, particularly Bitcoin, have already been seized by individuals seeking to use them for money laundering, the purchase of illegal goods, or the circumvention of capital controls. Despite these problems, crypto's popularity and use have been fast increasing recently, to the point that it's on its way to being a major disruptor of the global economy in the future years. As a result, numerous businesses, financial institutions, and investors, many of whom are suffering from FOMO, are attempting to assess the financial benefits of being associated with crypto. Approximately 300 million individuals, or 4% of the global population, use cryptocurrencies in some form, and some industry players anticipate that number will grow dramatically by the end of the decade. According to Gartner, at least 20% of big organizations will utilize digital currencies for payment, storage of value, or collateral by 2024, causing present financial networks and business models to be disrupted. Stablecoins, which are tokens pegged to a fiat currency, such as the US dollar, and hence more stable than decentralized currencies, have more than quintupled in value in the last year, rising from $29 billion to $163 billion. Their appeal can be attributed to the fact that they have a constant value and can facilitate more transparent and efficient value transfers than conventional payment networks. Trends in cryptocurrency to come. According to ZDNet, cryptocurrencies will be utilized for retail payments in 3 to 5 years, according to Aviva Lighton, a senior analyst and VP at Gartner who also co-authored the report, predicts 2022, prepare for blockchain-based digital disruption. In the coming years, investors will show a lot of interest in and adoption of cryptocurrencies as an investment vehicle, primarily as a hedge against inflation and as a gold substitute. Nonetheless, it is still an extremely dangerous investment. A Bitcoin is worth around $43,895 on February 15, 2022, down from a peak of $68,223 on November 10, 2021. Despite this, there's no hint that investors or businesses are losing faith in the potential rewards that cryptocurrency has to offer. This isn't solely due to speculating on cryptocurrency prices. Crypto has also piqued the curiosity of certain investors and businesses looking to enter the world of decentralized finance, or DeFi. Companies want in on the activity, even hedge funds are increasing their investments in Bitcoin, Lighten says. Banks are becoming digital asset custodians in order to assist these enterprises, and this is a global phenomenon, not just in the United States. DeFi is attracting institutional finance. Bitcoin accounts for around 0.08% assets, and some surveys predict that hedge funds would hold 7% of their assets in cryptocurrency in 5 years, Lighten added. Governments all over the world are now accepting blockchain and cryptocurrency. According to the Gartner report, 83 nations are currently experimenting with or deploying so-called central bank digital currencies, or CBDCs, which account for 90% of global GDP. China, which recently banned miners from mining all forms of decentralized cryptocurrency in favor of implementing its own, the digital yuan, has distributed over $5 billion in digital yuan to its citizens as of June 2021, and India's government is pondering how to tax cryptocurrencies as its central bank develops its own CBDC. To obtain mainstream acceptability, it will be necessary to crack down on crypto frauds and misuse. Due to criminals' inability to shift and spend funds off of blockchain networks, Gartner estimates that successful Bitcoin thefts and ransomware payments will actually fall by 30% by 2024. According to Chainalysis, cryptocurrency-related crimes, largely frauds and stolen assets, reached an all-time high of $14 billion in 2021, up from $7.8 billion the previous year. So-called rug pulls, in which developers construct crypto ventures that appear legitimate only to leave with investors' money, never to be seen again, are among the most recent sorts of scams. Meanwhile, North Korean cybercriminals stole about $400 million in digital assets in 2021 after launching at least 7 attacks on cryptocurrency platforms, primarily targeting investment organizations and centralized exchanges. However, with Bitcoin usage expected to skyrocket, there is some good news: illegal behavior is at an all-time low. According to Chainalysis, illegal addresses accounted for only 0.15% of cryptocurrency transaction volume in 2021, down from 0.62% in 2020. Customer loyalty reward schemes are another benefit of blockchain in terms of the future of money. Customers have been hostile to loyalty and rewards programs for years because they are inflexible with their needs. When you sign up expecting you'll be able to use your points to get a product or a discount on a service, you'll be faced with rules and restrictions on how and when you can use them. Frustration and disappointment eventually lead to income and client losses. As consumers prefer online shopping, retailers are turning to blockchain technology to track and handle transactions in the hopes of improving the user experience by adding more dimension, flexibility, clarity, and transparency. The non-fungible token, or NFT, is perhaps the most technically inventive, financially profitable, and misunderstood blockchain-based crypto asset. NFTs are the digital equivalent of a one-of-a-kind piece of artwork valued at a high sum of money, such as a painting in the analog world. They can be anything from a tweet to a video clip to actual property like as real estate. It ultimately boils down to tokenizing the asset in the digital realm, whether it's an algorithm or code for a video or JPEG, or digitized land deed documentation. Whatever it is distinct and identifiable in the virtual world. Cryptocurrencies, on the other hand, are fungible in the sense that they can be exchanged for another cryptocurrency of equivalent value. NFTs are one of the more innovative aspects of the money of the future. Although most people still see NFTs as having little value, Gartner predicts that by 2026, NFT gamification, or GameFi, which combines video game elements like point scoring with blockchain technology to allow users to trade or swap game assets, will be able to propel an enterprise into the top 10 most valuable companies. According to Gartner's analysis, NFTs will become a more potent digital marketing tool in the next years, and more traditional organizations will likely auction restricted digital use rights for some of their distinctive intellectual digital property. This is true not only in video games, but also in sports, finance, and other fields. The Metaverse has arrived. There's a lot of speculation about what the Metaverse, the next generation virtual reality-powered web, would look like. Despite the instability of this mixed physical/virtual environment, the Metaverse will inevitably become a fully functional marketplace among other things where users can roam around as digital copies of themselves, shopping in virtual stores. Despite the fact that the XR Association is not owned by any single firm, Google, Microsoft, and Samsung are among members. Facebook has staked the most ground in this virtual world with a sophisticated marketing campaign that included renaming itself Meta. According to the firm, this digital marketplace will be a series of virtual settings where you may create and explore with other people who aren't in the same physical context as you. Among other things, spend time with friends, work, play, learn, shop, and create. Many say that the metaverse will be the area where retail commerce and cryptocurrencies intersect, despite widespread skepticism, anxiety, and outright animosity against the concept. While businesses begin to profit from DeFi, Lighten believes that consumers will see the consequences of spending digital currencies through the metaverse in a few years. We're getting there thanks to Facebook and NFTs, so we'll have to start paying for things with virtual, digital currencies. Consumers will become aware of the crypto world through Facebook, the metaverse, and play-to-earn games, according to Lighten. What we'll see in the metaverse in the next couple of years will perplex a lot of people, says Tal Eliashiv, founder and managing partner of blockchain-focused venture finance company Spice VC. There will be a lot of chatter, a lot of excitement, and initially very little to see. Eliashiv compares today's metaverse to the state of the web in the 1990s, when downloading an email attachment seemed to take forever. According to Eliashiv, the problem with the metaverse is that it requires a lot of technology to make it seamless and available for everyone, and that technology will improve quickly, making the early years appear very slow. I believe that in years to come, we will look back and wonder how we existed before it, he says. What's your thought on the future of cryptocurrencies? Write your comment below. If you like this video, make sure you're subscribed and have notifications turned on so you don't miss out on any future videos.